Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started.
Good day, traders. Stacy Burke from Stacy Burke Trading. Today we're going to be comparing the yen pairs, the yen crosses heading into non-farm payrolls and the BOJ, and a short video to just reinforce again the two main types of opportunities that traders will be looking for best trade setups, ones that can be scaled into, and those are pump and dumps and dump and pumps. And the key thing to understand with that is regardless of any type of setup, whether it's a 3-day setup, a 3-session setup, or an opening range breakout, day 3 longs, day 3 shorts, first red day, first green day, inside day, it will all culminate. An entry will always culminate in either a pump and a dump or a dump and a pump. Let's take a look. A lot of traders are asking still about that and a bit confused, but ultimately the pump is what gets traders chasing the momentum, and often that is off a stop hunt into existing short trades or a triggering breakouts, depending on the setup itself. And then the dump is the follow through where the market is not going to come back, whether it be for that session, that day, or maybe even heading into the end of a week as we see on a non-farm payrolls. So again, going back to the process and understanding opening range sets the initial high and low for the week, we can establish most recent weekly highs, weekly lows, until the market breaks out of those with our opening range once it's established. So we'll zoom in here. We're looking at the pound yen, and this is just again the process about targeting the highest probability opportunities when you're heading into a non-farm payrolls Friday. We had BOJ also on Friday for the yen pairs, and as I mentioned, whenever they tentatively are waiting to release whatever they're going to release, I will sort of step back and wait. Once payrolls is delivered, and this is the key thing, I got a lot of emails asking questions about after the payrolls about certain entries and what pairs and different things. The key thing to remember is that once that news is released, you're either going to get an explosive move or wicks on both directions, or the market will have some volatility and then continue as it's going to continue to trade. And that's when we go back to work. Once the data has been released, now I can go back to work. There's nothing left on the schedule. New York Open comes at 9:30. Depending on what instruments you're targeting, whether it's an index, gold, oil, or a currency pair, the market has already potentially digested that information. So if there's no explosive move, we go back to the understanding of the box. Where's the money? So stepping back, we had an opening range breakout on Tuesday on our pound yen pairs. Remember, we're talking about non-farm payrolls Friday. So walking back through the process allows me to take a bigger picture perspective. Now we took out the low of the previous week. So now we have other time frame traders into the market. Remember, the one question you want to ask yourself if you're about to enter into a potential 5-star opportunity, 3-star opportunity, is who is driving this market? If I'm trading inside of a day and I haven't broken out of any daily highs or lows or even a weekly high or low, and I'm inside of this range looking for a session trade, the question you want to ask yourself is, who is driving this market? Because as Dalton talks about, once we trigger other time frame traders into the market and we're looking for that bigger high of week, low of week, low of week, high of week opportunity, or high of day, low of week opportunity, now we have other time frame traders in the market. We've got all the players on the board, which means there can be some weight behind this move. There's bigger players driving the trade setup that I might be stepping into. That's what differentiates a 5-star from a 1-star. So that's the important thing to understand. So we have an opening range breakout. So going back to the playbook and understanding opening range, initial balance. Remember, we talked about in balance and out of balance. Dalton again. When a market goes out of balance, it carries with it greater risk and greater opportunities. So one trader said, does that mean we don't do anything if it goes out of balance? You've misunderstood. What that means is that when a market breaks out, now we've got other time frame traders into the market. Now we potentially may have a market that is setting up for a best trade setup. When it's in here, my odds of having a 5-star opportunity are very limited, but I can have session trades, high and low opportunities. But once we break out, now we're getting other time frame traders on board. And that's what's important to understand. So we have our day 1 breakout shorts, day 1 shorts in the market, day 2 shorts in the market. We'll just pencil these in. We have a market that's out of balance. We'll just change this to a darker green. Day 2 shorts in the market, and then day 3 shorts in the market, lower lows, lower highs. The market came back into balance on Wednesday, but we still have a market that is breaking down. Day 3 shorts, again, a false break, not out of balance. We're still inside of the low of Tuesday's opening range breakout. The market then proceeds to go vertical BOJ back up to the high of the week. Now, this is what's critical. This is before we come to the U.S. window in the New York session for the non-farm payrolls release. So we have a market that's broken down day 1, day 2, day 3. The market reverses BOJ, and you'll notice where it reversed from. So again, coming back to each and every day, when I look at a market, I want to know where my opportunity for either buying low or selling high is. That's a box. So each day, you should be able to identify a potential opportunity based on the box. The objective is always to buy low and sell high, or sell high and buy low. So on Friday, we come to the screen. We have a market that's broken out of the high of the week. Again, with several other pairs, we did not get a first bounce opportunity, but the market did break down. So after payrolls is released, now I can go back to work. The market has pumped up. So we've had a market that went vertical on BOJ and then pumped up in the London session. Took out the high of the week in our London session. It breaks down on non-farm payrolls. So again, we use the concept of trapped volume, up high, 3 levels of rise, all these things that we clearly go over in the playbook. Now remember, we're just comparing the two, pound yen, euro yen. These are the 2 yen cross pairs that I follow. Other traders may be looking at multiple other instruments. It's irrelevant. I'm talking about the process in this video. But we have a quarter level of trap volume. This is essentially, for of all intents and purposes, a 25 pip box. Payrolls goes vertically down, but does not give a first bounce entry. But what we do get is our universal entry criteria met. This is a 5-minute chart. And again, into our second hour, we have a 1-bar stop. We're talking about process. And this is, again, differentiating the once you have a thesis in place, the time frame is irrelevant. They pump it up into the second hour, give a universal entry criteria on our 5-minute chart. And you'll notice, again, these bull candles lift. Once this candle drops, it takes all of these traders, they are trapped. Everybody up top is trapped. We are in a 100 pip box. We're in the upper quarter of that box. 3 levels of rise. This entire quarter of volume is now trapped. So we've triggered breakouts at the high of the week, the high of the day. This market should behave how? It should fall fast and furious. Why? Because we have traders that are in the money, and this defies all logic. And what that means is that they lift the offers and then they pull the bids. When they pull the bids, the market drops. And so our entry gives an easy 75 pips plus, depending on where traders took profit. And again, I will typically look at the engulfment or breakout level especially when we have a previous day's high or low. Remember, our box levels are areas where the market can fail and reverse. And then timings. So we get down and we're into the New York Open in the last 15 minutes of that second hour, locking in the money if this was the pair that you traded. and getting off the screen. So coming back to the entry, once we have our thesis in place, broken down market, we want to see the pump and the dump. You can get in on the 1 minute. You'll notice the same pattern, 1, 2, 3, quarter level. So if we look at closer at the smaller time frame, 1 push, 2 push, 3 pushes, the engulfment for traders on the smaller time frame gives them a fill just underneath the quarter level. So remember what I'm talking about. Once I've got my thesis in place, I'm getting in, and I will continue to add until we get down into this breakout level on the vertical side. That gives me an opportunity to size into this trade all the way down. Once it breaks down through this pump up candle, I'm done. And again, we're above 50. And we're locking in the money once we get down into the bottom of our 100 pip box into our strike zone for taking profits. So coming back again, a quick review. High low of the week, 3 days of drop, the reversal on BOJ, the pump up to the high of the week, the break in structure and engulfment on payrolls, and then the collapse back down into the longs from the London session. An easy, low stress, very profitable trade opportunity after non-farm payrolls is released. Now, if we look at the euro yen, we have a market that, again, if we just define our weekly levels, we got a high low heading into the new week. We've got our opening range on our Monday. We'll just mark our levels off. We come in and we have an opening range Monday that establishes our initial high and low for the week, that rejects in the Asian session for a high of session, high of day opportunity on Tuesday, that pulls the market back inside. We had day one longs in the market. We'll just zoom in on this. Day one longs breakout on Monday, triggered in the market, but no weekly levels broken. Then we get our day two. Day three triggers day one shorts. So remember, just looking at this in simple terms, we have a market that triggers day two longs and then immediately comes back on our Wednesday and gets breakout traders stopped out. Triggers shorts, but closes back inside of the range. So again, understanding the difference between a failed breakout and where it closes. But you'll notice for traders who are looking for this failed breakout to be a low, we haven't taken out any weekly highs or lows of either the current week or the previous week, which again comes back to understanding that we are still inside. We're still inside. So we are now getting other time frame traders on board, but we haven't broken out of these other major levels. So heading into non-farm payrolls, we have day two shorts in the market, and again on BOJ, the market pumps up into the previous high of the day from Thursday. Prior to doing that, on our Thursday though, we've broken down through the opening range. We had an opening range breakout that failed, but in the process, we've made a lower low on the inside. Lower low and lower daily highs. So we had Wednesday's high of day, and then Thursday's high of day gave us a lower high of day. Lower lows, lower highs is the formula for, again, the pump and dump potential setup. Remember, we're coming to the screen for after non-farm payrolls. We're looking for a possible first bounce. Maybe if it presents, we need a 15-minute setup in order to do that. We have a market that's gone vertical on BOJ. We redraw our levels. So it goes through the high of the day, pulls back and fails, but again pumps up in the London session. We have a new high of day. They've gone higher, but we're still inside the lower highs. This market, we just redraw those levels heading into non-farm payrolls. And just coming back to the understanding of the box. There's my high of the box and my low of the box, and my goal is to be able to sell the high and buy low, or buy the low and sell high if that presents in the session that I'm trading for a best trade setup. On non-farm payrolls, if we back this up a little bit, we have a market that breaks down immediately into the 50 level of our 100 pip box. So again, you'll notice we're in a 100 pip box. They've pumped it up. We're into the upper level. Thesis is already that the high is locked in. We have 3 pushes and then lower lows, lower highs. The market goes vertical. And understanding that when it does that on payrolls, everything above there is now caught. Everything above there is now caught. This is a 1-minute chart. So what I mean by that is this. There's traders that are going to be long on 1 hour, 15 minutes, 4 hour, all these other time frames. And when they trigger the high of the day, obviously daily time frame traders may be on board. But here's the best part. No first bounce opportunity presented. And this is not a first bounce. Again, go back to the criteria in the playbook. This does not coil inside. And traders who, if they did take this, regardless if they took this trade or not, as soon as that engulfs, you would cut this trade. So without waiting for it to come back against you or anything else, but this is not a first bounce trade. This is the break in structure. The break in structure, going back just now to our normal trading playbook opportunity. If we have a broken down market on the inside and we're looking for low-hanging fruit, again, the low-hanging fruit trend continuation trade, page 96 in the playbook, the market gave a fantastic continuation trade on our universal 5-minute criterion. You'll notice again that when these candles engulf, this is the 5-minute chart, we've come off the quarter level inside of the high of the session, break in structure, pumps up 25 to 50 pips. 1, 2, 3 off the quarter level, engulfment, 10 minutes into the second hour. So remember, everything is timed and measured. So timing is key. We can't sell the high of the day. We look for the high of the session. We can't sell the high of the session. We look maybe at the high of the hour. We get our entry. Again, this is the 5-minute criteria. I want to get in above or better than the level, the number. What that does, so just in simple terms, is think of this. If this is a 25 pip box, my max stop loss is going to be above that bar. If it comes back up through here, we could be targeting a move back up through the next quarter level, major quarter level, 25 to 50 pips. Now, obviously, we have a broken down structure, the pump and the dump, for again an easy, low stress, 75 plus pip blow off move. After the news, we don't need to get in and gamble and try to guess and catch a big move or anything else. But now I can go back to work. The news is digested. This is 30 plus minutes after non-farm payrolls. I go back to work and I go back to my process and I look for my best trade setups. We have a low-hanging fruit opportunity for the move back from the top of our box, high of day, back through the low of the day for an easy blow off, lock in the money, and enjoy the weekend. So the process is everything. The process is everything. There is no, gambling, speculation, or anything else. The process works. Rinse and repeat, and then learn to scale them up in size. The process also helps to filter out the best pairs. This one, the euro yen compared to the pound yen, was probably maybe a better visual recognized opportunity because the previous day's high had been broken and failed. And then we have our break in structure for the collapse back through pound yen. The only differentiating factor is we redrew our levels outside of the box back up through the high of the day. Same trade setup, same opportunity. But in terms of visually recognizing, the previous day's high had been broken on BOJ, and then the 100 pip box, the breakdown, the pump up, and the low-hanging fruit continuation short trade. So focus on the process traders, filter out the best pairs, other time frame traders driving these moves. Keep it simple, manage your risk, lock in the money. Keep trading low stress, simple, rinse and repeat, and get off the screen. Have a great weekend, traders. Enjoy your day. 1% better every single day, and may the markets go with you.